Good. Okay, good morning, everyone. Welcome back to day 3 of the Macrofinance Society Virtual Summer School. Okay, good morning, everyone. Welcome back to day 3 of the Macrofinance Society Virtual Summer School. Okay, great. Okay, sorry about that. I had myself playing to myself on Facebook. Okay, so welcome back. Today, we're very happy to have Hanno Lustig from Stanford University. Hanno is actually a founding member of MFS, and so we're very glad to have him back. And he's going to be talking today about an asset pricing perspective on fiscal capacity. Floor is yours, Hanno. Just a reminder of the rules. We'll have, if you have a question, feel free to type it in the chat. We'll take pauses every few slides so that we'll have a chance to ask the questions. We'll take a break in the middle for about 15 minutes. So just like we've been doing so far. Thank you very much. Take it away, Hanno.
Okay, well, thanks, Alexi, for giving me the opportunity to talk about an asset pricing perspective on fiscal capacity. I'm actually really excited to get this opportunity because, as Alexi mentioned, I was sort of involved at the very beginnings of the Macro Finance Society, and fiscal capacity is kind of a topic that I think is right at sort of the intersection of macro and finance, and so I want to use this as sort of an opportunity for me to kind of advertise the questions that I think need some help from macro and financial economists who are tooled up to think about these things. Okay, so the way I envisioned talking about this topic is sort of by starting with what I would describe as sort of a backward-looking approach, where we kind of take a backward-looking perspective to understanding variation in the debt to GDP ratio. I would say that's sort of a more conventional approach. And then after that, I'll sort of advertise what I would call a forward-looking approach. And that is more akin to a traditional valuation approach to the question of fiscal capacity. And I'll sort of explain the questions that arise. As we go along, I'll try and advertise the methods that I think can be used to address these questions. But I'll also try and sort of advertise what I think are open questions. And as you'll see, there are quite a few open questions, I think, at the intersection of all these topics. Okay, let me see. For some reason, I'm having trouble here switching slides. Just a second. Okay, so let me scroll back here. Sorry about that. Not sure why that happened. Okay, so there's a vast literature in macro that sort of thinks about the topic of government debt sustainability, and obviously after the pandemic, we've seen a rise in debt to GDP ratios around the world, which has really increased the urgency of this question, right? So the question is, well, how much more debt can these economies really issue without getting into fiscal trouble? And what I want to do today is sort of look at the question of fiscal capacity using the lens of modern finance, right? And most of what we do in finance is, when we think about fixed income, we think about pricing of individual government bonds, like what is the appropriate yield for a 10-year government bond. We've set up dynamic term structure models, arbitrage models that are equipped to answer these questions. And we've made a ton of progress in that area. But what we typically don't do is think about the pricing of the entire portfolio. And so that's the question on the table today. What can we learn from these models that we typically use to think about bond prices, about the valuation of the entire portfolio? Now, you could say to me, well, Hanno, that's not a really interesting question, right? isn't fiscal capacity just what the bond market says it is? If you just compute the market valuation of treasuries, isn't that the answer? And I think that's a good question. I think the answer there is, well, maybe. What we're going to see is that it's actually quite hard, especially in the case of the US, not so much for other countries, to rationalize the way bond market investors value the entire portfolio of treasuries. Of course, that statement is predicated on a couple of assumptions that I'll spell out, one of which is that investors come up with some way of making expectations about future surpluses, and we're going to start by giving them rational expectations. And once you do that, you realize, boy, it's really hard to rationalize the valuation of treasuries, and then we'll think about what that means. So that's sort of the broader perspective. And we're going to impose no arbitrage restrictions throughout, of course. That's going to imply that the Treasury cannot create value through financial engineering. That's going to be sort of the central theme throughout, and that turns out to have bite. Okay, there's going to be some cash flow risk on the Treasury balance sheet, and that cash flow risk in the tax revenue process is going to have to be absorbed either by the spending process or by debt. And if you want debt to be risk-free, well, that's going to have some pretty big implications for either taxes or spending. And these are implications that I think in the literature haven't been fully explored. And so part of my mission today is sort of to spell these out and then sort of invite all of you to think more about what that means. The Treasury's ability ultimately to make risk-free promises is going to be really limited in an environment where you have output growth that is risky and is subject to too large permanent shocks. That's going to be the bottom line. Okay. All right. So as I said, I'm going to start by looking backwards, and we're going to start from the very beginning with a static government budget constraint. I'm going to use G to denote government spending, excluding interest expense. I'm going to use T to denote government tax revenue. And let's just, to make it more concrete, think about the US. So let's think about the federal government here. We're going to start from a static budget constraint. So the government spends G, raises tax revenue T. The stock of debt outstanding is denoted D. R is the return on government debt, and that could be the risk-free rate, but it doesn't have to be, obviously. And so if you iterate backwards on this static government budget constraint, then what you get is that the value of debt today is going to reflect the primary deficit, G minus T, that you've been running in the past. It's going to reflect that entire history and the returns on the debt, right? Okay. Now, we like to think about debts in relation to the size of the economy. So you can derive from this an expression for the debt to output ratio today. And that's going to be governed, obviously, by primary deficits as a fraction of GDP. It's going to be governed by the cumulative returns between 10 years ago and now, RT minus 10 to T, for example. And it's going to be governed by the growth rate of GDP between 10 years from now and now. And one thing you notice right off the bat, of course, is that if that ratio R over X, which is a ratio of the returns and the growth rate of the economy, if that tends to be smaller than 1, then it's conceivable that the government could get away with running deficits forever without causing the debt to output ratio to explode. Now, with that equation in the back of your mind, what I want to do now is actually, whoops, I don't know why this keeps happening. Apologies. It sort of skips forward sometimes, and I don't quite know when it happens. Sorry about that. Okay, so we're back. This is where I wanted to be. I want to look at U.S. post-war fiscal history, and sort of look at the drivers of the U.S. Debt to output ratio, and I'm going to lean on work by George Hall and Tom Sargent, who've done this for the U.S. I'm going to start after the Second World War, but if you look at their data, which they generously make available online, it goes back all the way to 1776. So there's really rich data set available here. Okay, so the first column here in this table tells you sort of R minus G. It tells you the gap between the nominal rate of return and the nominal growth rate. I'm going to do it decade by decade. The second column gives you the returns. Third column, real growth rate. Fourth column gives you the rate of inflation. And so what you can see here is that early on, after the Second World War, real bond returns were quite low relative to the growth rate of US GDP. What are the main drivers of that? Well, early on after the Second World War, there was a burst of inflation, which helped. In the 50s, there was really strong growth, and that continued into the 60s. At the same time, nominal bond returns were actually quite low. Part of that was what we would now call a little bit of financial repression in the first decade after the Second World War, where the government was essentially manipulating the yield curve to help finance the Second World War and perhaps part of the Korean War as well. But overall, in the first part of the sample, sort of the bottom line, the key takeaway is that real bond returns were quite low relative to the growth rate. The average gap is about minus 3.5% if you look at 1947 all the way to 1979. Of course, in the 1970s, things start to change because inflation picks up. 1980 turns out to be a very different decade. As Volcker starts to increase interest rates, the returns on the entire portfolio of debt, and just to be clear, that is exactly what we're looking at here, right? We're looking at the returns on the entire portfolio of treasuries. They're actually much higher now. They're up to 11.8%. And R minus G now actually turns large and positive. So there's kind of a big switch. You could argue that bondholders had been really financing the debt at very low rates before the 1980s, but that seems to radically change. And if you look at the entire sample from 1980 to 2020, the gap between R and G now is still 1.5%. So it's switched signs. So just to kind of summarize, if you look at this picture, you kind of can tell that the 1980s and to some extent the 1990s were dramatically different from what came before. Bottom line is, if you look at the entire portfolio of treasuries and you compute the returns on that, then it's not entirely obvious that the return on that portfolio is always lower than the growth rate. In fact, there are 2 decades when returns were actually quite a bit higher than the growth rate. And that's important to point out because in the 1980s, the debt to GDP ratio, as you probably realize, in the US was actually quite low. But if we would find ourselves facing a similar gap between R and G today, when the debt to GDP ratio is not 30 or 40%, but well in excess of 100%, that would obviously have quite dramatic implications for the government's ability to roll over the debt. So just to summarize, if you look at the main drivers of the debt to output ratio in the post-war, you see low real returns of 50s, high real growth in the 50s and 60s. That's what's helped the US get the debt to GDP ratio down from well above 100% at the end of the Second World War to 30, 40% at the end of the 60s. But in the 80s, we saw really high real returns. And that's sort of a cautionary note that if you look at the entire portfolio, you do see these long periods of time where growth rates and returns diverge. Okay, so that's what I wanted to say about the U.S. Post-war experience. And as I said, if you're interested in this topic, there's a great paper by George Hall and Tom Sargent that does all this much more carefully. Let me pause here for a second to see if there are any questions.
Yeah, so we have a question. Julian, do you want to jump in and ask it by unmuting yourself?
Sure, yes, thank you. So I had a quick question regarding the table on R. I guess you're looking at ex post real return, is that correct? And so if so, do you know why they were low? Because ex ante R was low or because of unexpected inflation?
Okay, so that's a great question. So in the second column here, Julian, you see the nominal returns, ex post realized nominal returns, decade by decade on the entire portfolio. And then the fourth column, that's the realized rate of inflation. It seems like in the 70s, even though inflation went up, it seems like bond returns didn't exactly go up one for one, right? So you could argue there that part of what you're seeing, and that's what you're getting at, is the effect of bond investors being surprised. In the 80s, what happened was sort of the opposite. Volcker used to complain that investors weren't lowering their inflation expectations, even though he was aggressively raising rates. And you can see, presumably, the effects of that, because nominal returns now are very high, even though inflation was actually slowly coming down. There's certainly the effects of surprise inflation in the 70s, and I think that's what you're getting at. In the 80s, you kind of see perhaps some evidence of inertia in inflation expectations and very high nominal bond returns, even though inflation was slowly trending down. I think there was another question.
Thank you.
Are there any other questions anyone wants to ask? I don't see any in the chat.
Okay, good. All right.
Feel free. Okay. Okay, let's keep going.
Okay, so let me return to this sort of backward-looking expression for the debt to output ratio. If you put yourself in a deterministic economy for a second, where the growth rate is not stochastic, then the government's cost of capital is obviously the risk-free rate. All securities are under risk-free rate because there's no risk. Well, now what you could do, obviously, is you could just replace the cumulative return between T minus J and T with the risk-free rate compounded over that period. The growth rate is not stochastic either. And so you get the sort of familiar expression for the debt to GDP ratio as a function of past deficits, the risk-free rate, and the growth rate. And as quite a few economists have pointed out, most notably Olivier Blanchard in his presidential address, when the risk-free rate's always lower than the growth rate, the government can run deficits without causing D over Y to explode. And there's a very nice paper by Mirotra and Sergeyev that sort of explores these dynamics in low interest rate environments in a bit more detail. Okay. Now, it's interesting to think about a steady state from that equation, right? So if we sort of set the debt to GDP ratio to a constant, and this is a deterministic environment, so we can do that, then what you see immediately is that the government can roll over the debt because you get an expression for the debt to GDP ratio that's determined on the right-hand side by the steady state deficit. Why can the government do this? Well, again, if X is larger than RF, if the growth rate always exceeds the risk-free rate, that the government has that capacity and can run steady state deficits. Economists refer to this region of the parameter space as the dynamically inefficient region, and there's some interesting recent work by Ball and Mankiw and by Aguiar, Amador, and Ariano that sort of studies these environments to learn more about what governments can do when the risk-free rate is lower than the growth rate. Now, the question I want to ask then as an asset pricer is, well, can we just simply extrapolate from this to an environment where there's growth risk? And there, I think the answer is no. You've got to be extremely careful because in an environment with stochastic growth, if you tell me, Hanno, I'm going to put you in an economy where I'm going to drop you into an economy where the risk-free rate is always lower than the growth rate in every state of the world, then you've given me an arbitrage opportunity, right? So think about the following simple scenario where the growth rate's stochastic and IID. So looking ahead, the future always looks the same. Well, then the price dividend ratio on a claim to output is going to be constant. And so now if the risk-free rate is lower than the growth rate in all states of the world, then I know that the gross return on going long in a claim to output is 1 plus the price dividend ratio divided by the price dividend ratio, which is constant, times 1 plus the growth rate. That is going to exceed 1 plus the risk-free rate. Why? Well, because we know that in every state of the world, X exceeds R. And so now what you realize is that if you just literally take this condition to an economy with stochastic growth, that you not only giving the government a free lunch, but you're giving everyone a free lunch, right? It cannot be the case that R is always lower than the growth rate of the economy. And so we have to be careful about extrapolating from economies without priced aggregate growth risk to economies where growth risk is going to be priced. So the argument that the government can simply always roll over the debt has to be a bit more subtle. And I'll come to a more subtle version of this argument in a second. Okay. The other thing I want to point out here, and I'll come back to this in a second, is that in an environment with priced aggregate risk, saying that the entire portfolio of debt earns the risk-free rate, that's going to entail some restrictions. Okay, if you say that, you're going to have to make sure that the debt is actually risk-free, that it is a zero beta security, and that's going to have bite. And I'll come back to that in a second. So there's really two takeaways here. One is got to be careful with this R smaller than G condition in an environment with price risk. The other one is actually the condition that the debt be risk-free, that's going to have bite. It's essentially going to require that taxpayers insure bondholders, and that is not obviously a good description of what we see in advanced economies, and I'll come back to that in a second. Let me pause here and see if there are any more questions.
So Hanno, just real quick, if there is some kind of convenience yield on the debt or something like that, or is that something you're going to come to later?
I think it's actually you're 2 slides ahead of me. Yeah, so that's where I'm going. So here it is. So that was a great segue into my next slide. What if there are convenience yields? I think this is the sort of the more subtle version of the R lower than G argument, right? So there's a ton of evidence that US Treasuries are expensive relative to other similar securities, right? Investors seem to love US Treasuries because of their safety and liquidity, and as a result are willing to accept yields on Treasuries that are quite low relative to the yields they want on other securities. And there's a lot of evidence in financial economics to support this claim, right? You can, for example, compare Treasuries to TIPS, and you'll find that Treasuries are expensive. You'll compare Treasuries to corporate bonds, and you'll find if you hedge the default risk using CDS contracts, you'll find that Treasuries are still expensive relative to a synthetic Treasury constructed from a corporate bond. Treasuries are expensive relative to synthetic Treasuries constructed from, say, a German bond as well. I've done some work of that with Zhen Yang and Arvind, and there's some closely related work by Wenjin, who spoke to you all yesterday, together with Jesse Schrager on the same topic. So by and large, what you find when you carefully look at the data is that, yeah, Treasuries actually do seem to be expensive. They seem to earn a convenience yield. And that's what Alexei was hinting at, actually changes things a bit, right? Because now what you're telling me is, okay, the yield on a Treasury is going to be lower than the true risk-free rate, okay? And the gap is lambda, the convenience yield, okay? So what you could have now is a situation where you have low yields on Treasuries, right? And by the way, this lambda could move around over time, right? So typically what you see is that when volatility goes up in financial markets, convenience yields tend to increase. We call this sort of a flight to safety phenomenon, and that's going to pull down yields even more. So you could have a situation where yields are lower than the growth rate, but the true risk-free rate is higher than the growth rate, right? And so that kind of eliminates this arbitrage opportunity that I was outlining earlier, and it's probably a better description of the world. What you could do now is go back to that backward-looking equation and say, well, let's think about this for a second. How is this going to change the dynamics? Well, what you see now on the right-hand side is you have the sort of the accumulated true risk-free rate, RF, minus these convenience yields. So it will impact the dynamics of the debt-to-output ratio, holding constant primary deficits and the risk-free rate, okay? The thing about the demand for safety and liquidity is that as the government keeps supplying more bonds, and as the debt-to-output ratio goes up, there's reason to believe that convenience yields will decline. In fact, that was one of the key points that Arvind and Annette made in their first paper on this topic. And by the way, I think that should be Krishnamurthy Vissingjorgis in 2012. I think I got the date wrong on that. Apologies.
Just Hanno, yesterday, Wenxin also kind of presented some evidence on decline in convenience yield, and yeah, I'm just bringing that up because at the end of her talk yesterday, she was finding actually a negative convenience yield for Treasuries relative to German bonds.
Yes,
so,
yes, no, that's
interesting.
That's an important point. I think I'll come back to this, but I think if we're going to argue that the US has extra fiscal capacity because of convenience yields, which I think is reasonable, we have to be mindful of the fact that there's no guarantees that we'll have this privilege in the future. And it could be that there are changes, especially in the way global investors make decisions about which safe asset they use, that could dramatically impair the Treasury's ability to earn these convenience yields in the future. And Wenjin is right to point out that recently, at least if you use her measure of sort of CIP deviation at the long end of the maturity spectrum, it looks like Treasuries are no longer expensive. And that's an interesting fact that we should certainly pay attention to. Also in support of that fact is that foreigners started to sell Treasuries, especially longer maturity Treasuries, at the start of the pandemic. So there is some evidence that this appetite for US Treasuries on the part of foreign investors may have declined, and that of course would be an important fact to take into account when we assess fiscal capacity. So now if you go back to that steady state analysis, but now you allow for a convenience yield, then you get what I would call the sort of the more subtle version of the R smaller than G story, right? Where you have debt to output ratio now being determined by the steady state deficits. And you divide that by X plus lambda minus RF. So we could be in a region, the Goldilocks region, first of all, where the growth rate plus the convenience yield exceeds the true risk-free rate, right? And so in this region, the government can run steady state deficits, but they're going to have to be small because if the government runs really big steady state deficits, what's going to happen is that these convenience yields, as you increase D over Y, will decline to the point where X plus lambda now falls below RF, and now you're in what you could call the austerity region, and the government now has to switch gears and run steady state surpluses. There's a very nice paper by Mian, Straub, and Sufi that analyzes these dynamics, taking into account the effects of convenience yields. Most of this analysis in this sort of backward-looking part of the literature typically happens either in versions of the economy where there's no priced aggregate risk, or economies that are deterministic. When you really want to insist that the debt be risk-free, and I've made this point before, in an environment with priced aggregate growth risk, there are going to be additional restrictions that have to be imposed. And I'll come to that in a second. So that's sort of what I wanted to say about this backward-looking approach to thinking about fiscal sustainability. You're thinking about, well, what governs the dynamics of the debt to output ratio if we take sort of this backward-looking approach. And what you end up with is conditions that relate the risk-free rate to the growth rate, or the risk-free rate minus the convenience yield to the growth rate, okay? What I want to do next is think more about the pricing of a claim to future surpluses, and I'll call that the forward-looking approach. Some people refer to this as the government's intertemporal budget constraint, or you could also call it the government debt valuation equation. That's what I want to think about next. But I wanted to pause here and see if there are any other questions. So far what we've been doing is obviously fairly straightforward and simple. That was just a warm-up for what I want to talk about next.
Any questions right now? Anybody? Feel free to raise hand or type in the chat.
Okay.
Hanno, just real quick, anything on you mentioned you went over the US experience, but you know, one country that always comes up in these discussions is Japan. So is that a place where you would say that R has been less than G for longer? How would you think about
that? That's a great question, and actually one that I'm currently thinking about in some ongoing work with Yili Chen and Hal Cole. Japan's really interesting. So we started to dig into the Japanese case, and one thing you notice is that if you look at the Japanese flow of funds, is that private investors have been net sellers of Japanese government bonds pretty much since 2015. So another way of saying that is that the Bank of Japan has been absorbing more than the net supply of Japanese government bonds if you exclude T-bills, so excluding short-term securities. And in fact, today, the Bank of Japan has an explicit yield curve control policy in place. I think they cap yields at 50 basis points. So the first thing to note is that when we look at the market value of Japanese government bonds, you have to raise some questions about whether these are really market valuations, right? But essentially, when bonds are traded in Japan, you're merely trying to predict what the Bank of Japan will be willing to pay for this bond. Now, obviously, investors can short these bonds, right? And so you're probably thinking, well, if you think they're overpriced, why don't hedge funds short them? And actually, sometimes they do, but often they get burned when they do that. And I think they've taken to calling this the widow's trade in Japan, or the widowmaker's trade, because it's obviously a very risky trade. So the first thing I'd say is not clear that those are really market values. The other thing I'd say, and this is where this equation comes in handy, is that you could think about what the Japanese central bank has been doing. Partly is shrinking the supply of Japanese government bonds that is actually available to private investors, and thus sort of manipulating the convenience yield. I think if you'd ask Arvind, that's the way he would think about what the Bank of Japan is doing. So they're kind of boosting this lambda. Essentially, the only investors who are holding Japanese government bonds are financial institutions now who presumably still need government bonds for various things, like to hold them as collateral. But if you just look at, for example, Japanese households or even mutual funds, they hold almost no Japanese government bonds because they probably all agree that the returns are just too low. That's one part of the answer. A second part of the answer is that what you really want to do when you look at Japan is consolidate the central bank, the Treasury, and the pension fund. And if you do that, what you realize is they're doing a version of the carry trade. That is to say, the way all of this is sustainable, because you're probably wondering, well, how the hell can they keep doing this, is they're sort of borrowing at very low rates, artificially low rates, and then they turn around and invest in foreign equities. And these are fairly large positions they take if you consolidate the central bank with the Treasury and the pension fund. So in some sense, they're trying to earn, on average, higher returns abroad by earning a currency risk premium and an equity risk premium. But of course, there's risk involved in doing this, right? And so one could imagine that if there was a massive appreciation of the yen or a huge decline in equity markets, a sustained decline, that this strategy could end up in trouble. But Japan is certainly an interesting and understudied case, and we're hard at work trying to make sense of what's going on there.
I mean, your point, I think, is well taken, that you can think of, you mentioned financial repression earlier. You can think of it as manipulating the convenience yield in a sense. We tend to think of convenience yield as something that just arises naturally, but it could be driven by institutional forces and financial repression in the extreme.
Yeah, exactly. I think ultimately who's being taxed here is the real question. I think in Japan, the answer would have to be ultimately depositors. There's a large base of depositors, yen depositors, who are earning extremely low real rates. You might ask me, well, why don't they invest in other securities? That's a great question, but there seems to be this inelastic base of depositors who are earning ridiculously low real rates in Japan and have been for a while. And I think they're essentially, to some extent, financing this whole operation, and you could call that financial repression. But I think this is something that we should be thinking more about. It's a great question. Okay, so I want to switch gears now and sort of leave the backward-looking approach behind, and now think about what I would call the forward-looking approach. And what we're going to do now is put a model on the table, an asset pricing model, where you have priced aggregate growth risk, excuse me. And what we'll see there is that the government's ability to make risk-free promises is going to be limited when growth is risky, even if on average the risk-free rate is smaller than the growth rate. We're going to insist on pricing the entire government bond portfolio. We're going to price other assets. And we're going to realize that maybe the risk-free yield curve is not the right discount rate for valuing the entire government portfolio. What we're going to do now is go back to that static government budget constraint, but what we're going to do now is iterate forward. So let's take a look at this budget constraint. On the left, you have government spending. On the right, you have tax revenue, T, and you have the value of the portfolio of outstanding government debt, which is given by Q, quantity, times P, the price, and H denotes the maturity of zero coupon bonds without loss of generality. We're just going to focus on zero coupon bonds here. So just think of the Treasury portfolio as a portfolio of zero coupons. We're going to impose no arbitrage restriction. That is to say, we're going to impose that the price of a 10-year bond is the properly discounted value of a 9-year bond at the end next year. And when you impose these no arbitrage restrictions and you simply iterate forward, what you're going to get is an expression for the market valuation of debt on the left-hand side being equal to the present discounted value of future surpluses up until cap T, let's say 100 years from now, plus the discounted value of debt outstanding 100 years from now, okay? Now, we're going to argue that tail on the right-hand side here, that is going to go to zero, and I'll talk more about this. If you properly discount the value of debt outstanding, say 100 years from now, you're going to discount that not at the risk-free rate. Why not? Well, if debt and output are co-integrated, there's some output risk in the debt, even if it's risk-free, by the way. And so you're going to discount that at the risk-free rate plus a risk premium that reflects that growth risk. So that is going to tend to zero. And what you then end up with is that the value of debt is going to be the properly discounted value of future government surpluses. By the way, this expression goes back to early work by Hanson and Sargent and Hanson, Roberts, and Sargent. So obviously, lots of economists have thought about this equation before us. This equation is an interesting one. It holds ex ante both in real and nominal terms. So it doesn't really matter. You could relabel the nominal pricing kernel as a real pricing kernel, and then you could think about T and G as real variables. It also holds even if you allow for sovereign default. Obviously, if there's default risk, that's going to affect the market valuation of debt, but it doesn't change the fact that the full value of debt has to be backed by future cash flows. It doesn't change that one bit. And it also doesn't depend on market completeness, right? So this is just a very general expression as long as there's no arbitrage, and that no arbitrage condition holds, and the transversality condition holds. This essentially has to be true. Now, the transversality condition plays a key role, and so I want to talk a bit more about that. It will hold even if the risk-free rate is smaller than the growth rate. That's the first thing I want to point out. And to make that point, let me give you a simple example where the debt to output ratio is constant, okay? Well, if the debt to output ratio is constant, and you can take the D out of the expectation operator, and what you end up with is the expectation of M times Y cap T. That's what we call an output strip that pays off cap T periods from now. Obviously, that's a very risky instrument. It reflects all the output risk. And you can't discount that at the risk-free rate. You have to add what we would call the equity premium, the unlevered equity premium, or the market risk premium, whatever you want to call the risk premium on a claim to output. And we know, going back to work by Hanson and Singleton and Mera and Prescott back in the 80s, that's substantial, okay? So it's entirely natural to think that we're in an environment where, on average, now the risk-free rate is smaller than the growth rate, but the risk-free rate plus the risk premium will exceed the growth rate, and that risk premium, again, we think is a fairly large number. Let me pause here to see if there are any questions that come up thus far. No. Okay.
Did you, Hanno, just real quick, if
Yeah.
you said there's something in there where you're assuming something away about rational bubbles, right? Like something like the debt to output ratio just going to infinity or something like that.
Yeah, so that's a good point. So anytime you have a stationary process for the debt to output ratio, this result will hold. So I've given you a simple example where the debt to output ratio is constant. That's obviously very simplistic, but anytime the debt to output ratio is stationary, you can show that as long as the risk-free rate plus the risk premium is bigger than the growth rate, this condition will hold. So in that sense, it's quite general. Now, this equation, as I said, there's a long tradition in macro of thinking about this equation, going back to some early work by Hansen, Sargent, and Sims, obviously. Recently, people in financial economics have also started to think more about this equation. There's some really interesting work by Max Croce, Lucas Schmidt and co-authors, and Mike Chernoff and co-authors that also thinks about this equation. Okay, what is this risk premium, you might wonder? Let me give you an example from what I would call one of the workhorse models of dynamic asset pricing. Suppose you take a disaster model, and I'm going to take my cues here from a really nice paper by Dave Backus with Mike Chernoff and Ian Martin, where they calibrate the risk of disasters to match the moments of a panel of international consumption data that was gathered by Robert Barrow, Emi Nakamura, John Steinson, and co-authors. And in this model, the probability of disaster is about 1%. Disaster is a 30% drop in consumption. We're going to choose the coefficient of relative risk aversion to match the levered equity premium. That's about 6.47%. And then we unlever it to get what I would call the output risk premium, the unlevered equity premium. And you get a number like 3%, 2.93% to be correct. So the condition for dynamic efficiency here would not be to say, well, let's compare the risk-free rate to the growth rate, but you would take the risk-free rate, add 2.93% and compare it to the growth rate. And that obviously makes a dramatic difference because for most reasonable numbers, what you would find now is that RF minus X plus 3% is probably bigger than zero. And so that transversality condition would be satisfied. So it changes your perspective on things. The bottom line is in economies with aggregate growth risk, you can't simply compare the risk-free rate to the growth rate. Now, I think this is partly what Alexei was getting at. It is true that you can write down models where everyone's completely rational and this transversality condition fails. So I don't want to obviously cast any doubt on that. That's certainly true. These are typically models where there are no long-lived investors, because if there are long-lived investors, then the transversality condition is essentially an optimality condition for a long-lived investor. But if you write down models, for example, where you have overlapping generations of agents who only live for a couple of periods, then this is no longer an optimality condition, and you can construct equilibria where this transversality condition fails. And so you can have theories of rational bubbles, and there's a large literature on this. This was an idea that was explored starting by in work by Samuelson and Diamond, and then Blanchard and Watson. So there's sort of a long, proud tradition of thinking about this. A couple of things I want to point out that I think are sort of limitations of this way of thinking about fiscal capacity as well. You know, sure, we can write down models of bubbles in bond markets, but typically in these models, you would also be able to generate bubbles in other long-lived assets. Equities are long-lived assets, undeniably, right? Duration of equities is probably higher than the duration of the government bond portfolio. So then the first question is, well, if you think there's a bubble in bonds, why not in other asset classes? It seems like we run into trouble there. The other challenge for this explanation is that we're going to find a puzzle for the US. As I said, it's going to be hard for us to rationalize the valuation of government debt in the US, but that's not necessarily true for other countries. When we look at other countries who consistently run primary surpluses, the gap between our measure of fiscal capacity and the valuation of that is actually fairly small. We have a paper where we look at the UK carefully, and those gaps there are actually smaller. I'll talk a little bit about that in a second. So you then also need to ask yourself, well, what's so special about the US? Is the US really the only country that's figured out how to sustain these rational bubbles? That doesn't seem like a compelling explanation. Why not the UK? Why not Argentina? Right? These are all questions that I think just pointing to failure of the transversality condition doesn't really begin to address. So what we're going to do is just sort of go with what I think is the standard approach in asset pricing, rule out these sorts of bubbles and see how far we can get. So we're going to assume that the transversality condition holds. But again, it is certainly true that one could write down models where this is not the case. Okay. Now, I've already alluded to the fact that bonds are different. Treasuries seem to earn convenience yields at different maturities. If you assume that these convenience yields are constant across the maturity spectrum, and you again iterate on that government budget constraint, you now end up with a different version of the government budget constraint, where the debt is not only backed by the properly discounted value of future surpluses, T minus G, but also by the seniorage revenue that the Treasury generates from selling these securities. Because every time the Treasury puts its stamp on a bond, that bond sells for a price that exceeds the no arbitrage value, right? So if Apple creates a security that has a claim to the same cash flow, it's going to sell at a lower price. That gap is lambda. And that's the source of seniorage revenue for the government. And so when you look at the intertemporal budget constraint, you have to take into account this additional source of revenue. And so what we're going to try and do is quantify how much this is. And we're going to find that it's substantial, but it doesn't entirely get us out of the woods in terms of rationalizing the valuation of treasuries. Okay. Now, why are bonds special? So there is a large growing literature in macro that thinks about the specialness of government bonds. In most of these models, government bonds are special because they allow investors to self-insure. And I think that's certainly one important motive for holding government bonds. For example, there's some recent work by Markus Brunemeyer, Sebastian Merkel, and Yuli Sannikov, where they analyze a model in which bonds are the only assets household can hold to hedge against idiosyncratic risk. If the government has a monopoly of issuing these securities, that's a source of seniorage revenue, obviously, right? And that generates extra fiscal capacity. Okay. Now, one tension you notice when you start thinking about this is that in this class of models, the seniorage revenue that a government would earn would be larger in less developed financial economies where there's more idiosyncratic risk, right? Because the more unspent risk there is, the more useful these special securities are. And that's going to allow the government to extract more seniorage revenue. But that's not quite what we see, right? It's certainly not true to first order that less financially developed economies have governments that earn more seniorage revenue. In fact, it seems like it's almost the opposite. It seems like global investors sort of pick one country and say, well, you're going to be the safe asset supplier. Before the First World War, that was the UK. Now it's the US. And they allocate extra fiscal capacity to this one country. Okay. I'll come back to this in a second. All right, so now what I want to do next is think more about the risk on the Treasury balance sheet. So if you go back to the intertemporal budget constraint, it says, well, the debt is going to be equal to the present discounted value of primary surpluses. Now, you might think, well, Hanno, this is a very abstract exercise, right? Because, you know, you're sort of, maybe you're thinking about some representative investor who somehow ends up with this claim to these primary surpluses. But the key thing to realize is if you have a mechanical strategy where you're constantly buying all the new issuances of the Treasury, and then you're holding this until maturity, you literally end up with these cash flows. So this would be the cash flows earned by a very broad bond portfolio that holds essentially the market. Okay, the surpluses are the cash flows on this investment strategy, and so the first thing to note is that they're obviously highly pro-cyclical, right? If you look at surpluses over GDP in the US, and this is true for most advanced economies, you see that there's a lot of business cycle risk. Why is that? Well, it's because taxes tend to decline in recessions as a fraction of GDP, and spending tends to go up. So in some sense, there's wrong way business cycle risk. The surplus gain carries extra business cycle risk. In the long run, surpluses are co-integrated with output. So there's long run output risk as well. There's business cycle risk and long run output risk. So these are two sources of risk. In fact, if you compute the GDP growth beta by running a regression of spending growth over longer horizons on GDP growth, let's say 1 year, 2 years, 3 years, what you see on the left-hand side for spending is you get negative betas. So these cash flow betas are negative for spending, but they're very positive, significantly so for taxes. So there's a big gap between the output risk embedded in the tax process and the spending process. And that raises the question, well, if you put these two things together, how are we going to keep the debt risk-free, right? Because we have a long position in a tax claim that's, by objective standards, quite risky, and a short position in a spending claim that's actually quite safe, okay? So that leads us to think about the Treasury balance sheet. On the left-hand side, the asset side, you have tax revenue. On the right-hand side, you have spending, and then you have the market value of debt, okay? So we're going to think about all of this in terms of the market values. So PT denotes the value of a claim to all of the tax revenue. PG denotes the value of a claim to all of the spending. And what you notice is that the risk in spending has to be absorbed either by the risk in taxes or by the market value of debt. That's going to impose some tight restrictions. If we write down an expression for the expected return on the entire portfolio in excess of the risk-free rate, what you're going to get is that weighted average of the risk premium on the tax claim and the risk premium on the spending claim. You could also write it in terms of the betas of these different portfolios, right? So the beta of the entire Treasury portfolio is going to be determined by the beta of the tax portfolio. So you have a long position in the beta of the in the tax claim and a short position in the spending claim. Okay, what does it take then for debt to be entirely risk-free? Well, obviously, the first way to think about it is, well, when you wake up in the morning and you recompute the value of that claim to primary surpluses, that cannot change, because if it did, it wouldn't be risk-free. Okay, so it's actually risk-free debt is a pretty radical concept if you think about it that way. Sargent in his work calls this a measurability condition, and it's a restriction that's going to have bites. In asset pricing terminology, we would say, well, the beta of D, which again is determined by this expression. Betas here are the covariances of the pricing kernel with returns, so it's the conventional definition of beta. Beta of D has to be 0. Well, if the beta of D has to be 0, you plug that in here and you manipulate this equation, then what you end up with is the condition that the riskiness of the tax claim is going to have to be equal to the riskiness of this spending claim times a ratio that is smaller than 1, which is given by the value of the spending claim divided by debt plus the value of the spending claim. So anytime we have positive amounts of debt outstanding, it has to be true that the tax claim is less risky than the spending claim in order for the debt to be risk-free. And the more debt you have, the lower the riskiness of the tax claim has to be relative to the riskiness of the spending claim. Now, if you have countercyclical government spending, that means that G over Y goes up in bad times. That means that beta G is actually low. So if you're in the business of having countercyclical government spending, then in some sense, that puts even tighter restrictions on the tax revenue process. Okay, if you want to insure bondholders, that's going to require a tax policy that implies even lower beta T, or in other words, that's going to require you to increase taxes in bad times. So it seems like we can now go back to where we started, right? So we started by saying, well, we sometimes assume that the government can just roll over the debt at the risk-free rate. What we realize now is that if you think about this question in the context of an economy with priced aggregate growth risk, you need to impose tight restrictions on taxes and spending. And in fact, you have to impose that the tax process be less risky than the spending process. What this means is that you cannot both insure bondholders and insure taxpayers at the same time. That's what this rules out. This equation says, look, there's a trade-off. If you want to insure bondholders by keeping the debt risk-free, then the tax process really can't be that risky, and you're going to have to increase taxes in bad times when the pricing kernel is high. If you look at what advanced economies actually do, it doesn't look like that condition's satisfied, right? And so even though the debt is almost priced as if it's risk-free, it certainly doesn't look like this condition is satisfied when you actually look at their spending and tax revenue processes. Okay.
Hanno, just to make sure I got it, it's you could also cut the spending. You're kind of taking the spending as exogenous and talking about adjusting either tax, yes, putting the risk on taxpayers or the bondholders. And you're saying in practice, we don't really see the spending doing that.
Yes. So that's right. So very good point, Alexei. Thanks for asking me about this. So if we go back here, these are the betas with respect to GDP growth of spending on the left-hand side over different years, 1, 2, 3, 4, 5. And the same thing for taxes, right? So what you do is you say, take 5-year growth rates in tax revenue, regress that on 5-year growth rates in GDP growth. And so what you see is that the betas of the tax claim are always higher than the betas of the spending claim, right? So taxes seem riskier at all horizons. You can take, as you said, the sort of the spending process is exogenous. There's a large literature on optimal taxation that does that. It goes back to Lucas and Stokoe, the classic paper where G is just whether you go to war or not. You go to war, G is very high, it's completely exogenous. But in modern economies, of course, G is mostly about transfers. So it's a bit different, but you can certainly take G as exogenous, and then if you want to keep the debt risk-free, taxes have to adjust. And what I'm saying is that that tax process will not look like the one you see on the right-hand side here, right? Because what this condition says is sort of the exact opposite of what we see in the data, that the tax process, the betas of the tax process should be lower than the betas of the spending process. Does that make sense?
Yeah, I guess the part we don't know is the long run piece, like the cyclical behavior is going the wrong way. What's obviously hard to tell in the data is the long term beyond these horizons.
We assume that in the long run they're equally risky. So so they're all co-integrated with GDP. So the betas would converge to 1, which you sort of see here happening, but of course it's hard to compute these, and I guess that's what you're saying with a great deal of accuracy. But I agree with your point. We cannot rule out that if you were to sort of trace out these betas over much longer horizons, that there's some sort of reversal. I think that's sort of what you're saying, right? And that could sort of help to explain why the betas of the tax claim and the spending claim seem to go the wrong way in the short run. We can certainly not rule that out. What we typically do in our work, I'll come back to this, we assume that both taxes and spending are co-integrated, and that means that the betas in the long run just go to 1. So in the short run, they go the wrong way. In the long run, they go to the same value.
What you're saying is you have to believe that eventually somewhere between the cyclical and the long run that will raise taxes. Like in the very long run, the beta is 1. In the short run, it's going the wrong way. So you'd have to believe that, you know, it will raise taxes at some point. Japan will raise taxes at some point in the future, something like that.
Yes, but the point remains that, at least from the perspective of an infinitely lived investor and household, you cannot, at least without convenience yields, I'll show you what happens with convenience yields in a second, but without convenience yields, you can't insure taxpayers and bondholders at the same time. There's always, right? Because if you want to make sure that when the bondholder wakes up in a high marginal utility state and the value of his portfolio does not go down, then that has to mean that you're sort of committed to increasing tax revenue in that state of the world at some point in the future. And that is bad news for the taxpayer.
Bad news. I guess the bondholders and the taxpayers are probably overlapping groups. So. That's a fair point. So in our work, we're thinking about an economy where there's heterogeneity and market incompleteness, and even in that world, all these statements are still true. So you could ask yourself, well, if I take some group of households and I call them the taxpayers, and they're in this insurance scheme, and I fund the insurance scheme with risk-free debt held by whoever's not in the insurance scheme, can I insure taxpayers while keeping the debt risk-free? And this logic still applies. The answer is no. In general, you cannot, because at the margin, they all have the same valuation of aggregate risk. And so you cannot fund an insurance scheme that says I'm going to keep the debt risk-free, but that is valuable to the people in the insurance scheme. There has to be something else going on. That something else could be
convenience yields, right? So we've talked about convenience yields.
We do have a question here in the chat. Who do you want to ask?
Yeah.
We do unmute yourself. If not, I can read it out. Okay, well, who was asking whether you're talking about real or nominal bonds?
Okay, so what I'm saying here is let's explore the case in which the beta is 0. So you take the entire portfolio of treasuries, and we're saying it is risk-free. So it's going to earn the real risk-free rate. Now, what is that portfolio of treasuries? What's the duration? We're sort of not thinking about that. We find it useful to sort of immediately think, well, what would it mean for this entire portfolio to be essentially risk-free? Now, you could say to me, well, that's not quite what the Treasury does. And I agree. They have a portfolio with a duration that's 4 to 5 years. They have some nominal, some real debt. But overall, that portfolio earns actually a return that's only 100 basis points higher than the risk-free rate. So even a little bit less than that. So this is not a bad benchmark to start from. That's sort of the motivation. Let's think about what would have to be true if the entire portfolio was risk-free. So this raised some questions, right? Because governments around the world provide massive insurance to their citizens. We've seen in the pandemic that there were massive increases in government spending. They allowed tax revenues to decline, but then at the same time, they seem committed to providing insurance to bondholders. There is fundamentally, and that's what I was trying to outline, this trade-off between insurance of bondholders and taxpayers. And that's obviously not something you can think about when you're analyzing deterministic economies, right? So it seems in the real world, governments are committed both to keeping the debt risk-free, but at the same time, they also want to provide a lot of insurance to their taxpayers. And certainly in our standard models, there's a trade-off there, because governments cannot engineer risk away, right? If you sort of apply basic Modigliani logic, then that says that they shouldn't be able to do this. Okay. One potential way out of this, and I think this is in some sense an invitation for all of you to think more about this, is to think about convenience yields. Because when you have convenience yields, the left-hand side of the Treasury balance sheet now looks a little bit different. Not only do you have tax revenue coming in, but you have seniorage revenue coming in from the revenue earned by selling these treasuries above their, at prices above their fundamental value. And now that changes the equation for the beta of the tax process, right? So the trade-off in some sense now is a little bit less steep. Why is that? Well, beta of taxes is now a weighted average if the debt is risk-free, if the beta of spending and the beta of the convenience yields, okay? And so if you thought that the seniorage revenue from convenience yields is not cyclical at all, is not risky, has a 0 beta, then the trade-off is a little bit less steep, because now you have on the right-hand side P over G divided by D plus P over G minus P over K. That's going to help a little bit. But the really interesting case is if you thought that beta K is negative. So if seniorage revenue is higher in bad times, then that's now does allow potentially for a riskier tax process while keeping the debt risk-free. So in some sense, now you can insure both bondholders and taxpayers. Now, what does that mean, countercyclical convenience yields? Well, if in bad times and when you get flight to safety, the Treasury can sell these securities at a bigger premium that's obviously going to help. It's going to tend to push the beta K down. An offsetting effect there, of course, is that ultimately the amount of seniorage revenue you extract is tied back to your output, right? Because let's say that your debt to output ratio is constant. Well, there's output risk embedded in that claim as well. And that's actually going to tend to push the beta back up. So what we found in our work is that it's quantitatively hard to get this to really move things significantly, but at least qualitatively, it's an important channel to think about and to explore. And it certainly does suggest that at least some economies might be able to do both, that is, insure bondholders and taxpayers. And so I think this is worth thinking more about. Tying it back to what we said before, this is sort of the more subtle version of the R lower than G argument, right? There's big convenience yields. If you want to think about the entire debt portfolio earning the risk-free rate, that implies tight restrictions. If you impose these restrictions in a world with convenience yields, you might still be able to insure both bondholders and taxpayers. That's a quantitative question, and I'm going to show you some evidence later from our own work to think about this. But what I wanted to do here is just basically outline the trade-off that we're facing.
There's a question. Julian, do you want to ask your question?
Sure. I was trying to think about the counter-cyclical convenience yield that you were talking about. And it seems to me that you are thinking about a closed economy. But what if we think about an open economy? Could that come from, say, foreigners who expect the dollar to appreciate during global downturns? And so in that sense, they would want to buy the dollar. It would bring that convenience yield because it's a negative beta asset in that case during global downturns for them.
Yeah, that's a very interesting way to think about it. Absolutely. I think you're right that a big reason of why typically what you see is you see Treasury earning larger convenience yields when volatility spikes, because foreign investors historically have done exactly what you described, which is they flee to the safety of dollar-denominated treasuries, and that allows the Treasury to earn a larger convenience yield in bad times. And so in some sense, you could argue, and I think that's what you're saying, is that maybe foreigners are helping the Treasury insure taxpayers. And I think that's a productive way of thinking about it.
Yeah. And so that would explain why also the US is different from any other country.
It would. And I do think that the status of the US as the world's safe asset supplier is key to understanding US fiscal policy. But I do want to push back a little bit in the sense that if we take this equation seriously, quantitatively, we struggle a bit, because even though the business cycle properties of convenience yields have sort of the right sign, as you point out, in the long run, there's still sort of all this output risk embedded in that seniorage claim. As you know, in asset pricing, what really dominates everything, what dominates valuations for long-lived assets, is what happens in the distant future. And that output risk tends to push the beta of K back up. So that's sort of the force that fights this. But I agree with your general point. The US is special, I think. And that's one reason why I think we should be very careful in studying the US and then extrapolating from the US to the rest of the world. I think that's a recipe for probably poor policy prescriptions because of what you said. It's a very good point.
Thank you.
Another question. Corey, do you want to ask this one? Feel free to unmute.
Yeah, just curious. So it's actually agree with probably the evidence or intuition, right? The bondholders, they are insured during the recession, right? Bond price tend to increase. But right, in a general criminal, how this happen, right? So who actually purchased bond, right? other bondholders, I guess, must be the Fed or maybe some other actually economic channel there.
I see. So your question is who is purchasing?
Right, the bond rights as the bad time recessions, right? So I guess that's what the Fed does, right?
Right. So this goes back to Julian's question in some sense. I think what we've seen over the past 2 decades is, if you look at the longer end of the maturity spectrum, in bad times, the Treasury could rely on foreign investors to step in. And this was particularly salient during the great financial crisis, when foreigners absorbed most of the issuance at the longer end of the maturity spectrum. However, that is not what happened during the pandemic. In fact, if you look at the flow of funds, it's quite dramatic. Foreigners initially started selling long-dated treasuries, and they did so for a couple of quarters. That's a radical departure from what we'd seen before. And as you suggest, I think in your question, what happened is that the Fed stepped up to absorb the residual supply.
Right, exactly, right.
Yeah.
So you have the inflation there.
Right. So it's interesting to think about how the Fed's actions interact with a model like this one. There's some recent work by my co-author Stan van Nieuwerburg, together with Tim Landvoort and Vadim Elenev, and another co-author, Schultz, where they actually sort of look at that interaction, like how can quantitative easing increase fiscal capacity? Okay, I think that's a very interesting question. It's not one that I've thought deeply about, but it certainly seems very relevant. It seems like part of what the Fed and other central banks were doing was they were trying to make sure that at the onset of the pandemic, governments had enough fiscal capacity to do what they wanted to do. I think they were not only motivated by, well, hey, we're at the zero lower bound, and now the only way we can get long-term interest rates down to stimulate the economy is by buying treasuries. I think they were also partly motivated by a desire to allow governments to spend more, understandably, because obviously that is what was called for, given what was happening in the world. Okay.
We have one more question in the chat. Hanno.
Okay.
Pranav, do you want to jump in and ask it?
Hi, thank you. This is very good for intuition. I just wanted to know whether convenience yield, if convenience yield depends on the level of debt, how does that affect the intuition we have right now? Right.
So that's a very good question. So that is another countervailing force, right? So it is certainly true that in bad times, convenience yields seem to go up, but on the other hand, and that's what you're getting at, governments actually issue a lot more debt, and that will push the other direction, because demand for safety and liquidity is downward sloping. So if the government aggressively issues a lot more debt, that will tend to push down convenience yields, and actually also, again, pushes beta K back up. So that's a good point. In some sense, that is what is central in the work of Mian, Straub, and Sufi. Even though they don't take this forward-looking approach, they kind of take that backward-looking approach that I started out with. So if you're interested in thinking more about that, I think that's a good place to start in the literature. I will come back to the process for seniors revenue in a few slides and talk a little bit more about that. Okay. So before we move on, let me sort of give you what I think might be a very simple example that drives home some of these concepts a little bit better. Okay, so suppose we're in a simple economy where the risk-free rate is 1.5%, the growth rate is 2%, the risk premium is 3%, volatility of output growth is 3%. All of these are annualized numbers. Tax output ratio is 25%. And let's assume for now that tax taxes over output and spending over output are constant. So we're not even thinking about countercyclical fiscal policy. We're just thinking about all these ratios being constant. And the expected value of GDP is 10 trillion in first year. So tax revenue would be 2.5 trillion. Spending would be 2 trillion. We're going to run a surplus of 0.5 trillion the first year. And then after that, cash flow is expected to grow at a rate of X% over time. So now go back to that Treasury balance sheet. It's a very simple example, but I think it might help think about all this. So on the left-hand side, you have the present value of the tax claim, which is 2.5 trillion. That's the amount of tax revenue collected by the Treasury in year one, times 40. 40 is the valuation ratio, right? So this is a standard valuation exercise. Where does that valuation ratio come from? Well, you take the risk-free rate plus the risk premium, 3%, minus the growth rate. That gives you a multiple of 40. Over on the right-hand side, the liability side, you have present value of the spending claim, which is 40 times 2.25 trillion. That's the spending expected in the first year. Multiply that by 40, you get 90, and the difference is 10 trillion, okay? Now, note that in this case, the tax claim has a beta of 1, the spending claim has a beta of 1, and the debt has a beta of 1, right? Debt is quite risky and is about as risky as a claim to output, okay? Now, what would you need in order to have risk-free debt in this environment? I just wanted to illustrate that to drive home this point that, well, in an environment with growth risk, risk-free debt is actually peculiar. So now think about the government running a primary deficit of 0.05 trillion. So taxes is 2.2 trillion expected in the first year. Spending is 2.25 trillion expected in the first year. The spending multiple is still 40 because spending over output is constant. But if we want the debt to be risk-free, then as I've explained, the tax claim now has to be less risky, right? So the multiple is going to be higher. What is the beta of taxes? Well, it's 0.9. It's not 1. Given that the beta of taxes is 0.9, now the multiple goes up from 40 to 45.5. Why? Well, because that risk premium now is a bit lower. It's 2.7%, okay, whereas before it was 3%. That gives you that boost to the multiple. So now you're sort of in what you could call the Goldilocks scenario. This government can run, in fact, permanent deficits. By the way, note that the transversality condition here is satisfied, right? So transversality is satisfied. There's no funky business going on with the value of debt. So how can the government do this? How does this work? Well, what it's doing is it's sort of forcing taxpayers to insure bondholders, and the government collects an insurance premium for doing that. And that is the deficit of 0.05 trillion per year. That's going to be growing at a growth rate G, okay? Taxpayers are insuring bondholders, but what does that mean? It means that in bad times, taxpayers are committed to paying more, maybe not right away, but certainly at some point, okay? So it's not a free lunch is what I'm trying to say. This is not a free lunch. This is sort of saying, well, I'm going to put my taxpayers in the business of insuring bondholders. The Treasury is now running an insurance corporation where the insured are the bondholders and the taxpayers provide the insurance, okay? All right. What about acyclical convenience yields? Well, in the interest of time, let me actually go over this a little bit faster. So if you have convenience yields, then on the left-hand side now, you see this convenience yield term showing up. You have the present discounted value of all the seniorage revenue, okay? In this example, the government runs a primary deficit of 0.25 trillion. We have a convenience yield of 73 basis points, okay? Now, there's an offsetting effect because what you're saying now is that the true risk-free rate is 73 basis points higher. So it's no longer 1.5%, right? But it's a bit higher. That's why you see that multiple now being 30.996. Okay, so now if you compare the present value of the tax claim, the present value of the spending claim, you have 77 trillion. On the left-hand side, 69 trillion. You've got 2.2 trillion in convenience yield revenue, not trivial, okay? And the debt value now is equal to 10 trillion, which is partly the primary deficit and partly the convenience yield term. When you actually have countercyclical convenience yields, then the risk premium on that convenience yield senior rich revenue term goes down, and that pulls up the multiple for that K claim, and that allows you to boost fiscal capacity, right? So this is an example where you have countercyclical convenience yields. Now the multiple for the senior rich revenue is 50, much higher than the one for taxes and spending, and that allows you to actually get a big kick to fiscal capacity. And so now the value of that is boosted from 10 to 11.4 trillion. So this is just a simple example to try and highlight the main forces that are at play here. Okay, let me pause here. We're about halfway here. Next, we're actually going to really dive into this forward-looking approach and talk about the methods you can use to sort of apply this forward-looking approach and really assess and measure fiscal capacity. But before we do that, I wanted to pause to see if there are any questions.
We might want to take our break as well.
Yes, this would be a natural breaking point. I agree with that.
That's great. So let's take a 15-minute break. So
Okay.
At 10:47.
Okay, great. Thank you.
See if there are questions at that point, or move into the next part.
Yep. Thanks.
Great. We're back. We'll be back at 10:47. Welcome back. Are there any questions right now before we get into the next section? Okay. Hanno, let's keep moving.
Okay, great. Well, thanks, Alexi. Welcome back, everyone. I took the opportunity to get some coffee. It's still early here in California, so I think I needed a bit more caffeine. So feel free to interrupt me if you have questions. So what we're going to do now is dive into this forward-looking valuation approach that I've laid out to you. Right? Some people call it government's intertemporal budget constraint. You could call it a debt valuation equation. So the question on the table now is, well, as asset pricers, what can we do with this equation? Can we learn something from this equation? And we're going to take two approaches. One is sort of a model-free approach, and the other one is a version of this where we commit to a specific model. So let me talk a little bit more about this. The ultimate objective is to value the entire Treasury portfolio. As I said, in asset pricing, we tended to focus mostly on pricing individual bonds, but it actually doesn't really make sense to stop short of pricing the whole portfolio. We have the machinery at our fingertips to do this. We sort of have a couple of different papers that try and explore this, right? One thing you have to do, and Sargent pointed this out when he first started thinking about this intertemporal budget constraint, is you have to endow agents, investors, households with a model for forecasting future surpluses. Right? Obviously, without that, there is no way to actually make progress on this question. So first, what we're going to do is we're going to say, well, let's look at agents who are pretty rational. They have rational expectations, and they use either regressions or vector autoregression to forecast future surpluses. They do what econometricians would do. And what we're going to find there is that it's hard to make sense of the valuation of all US treasuries. And I've already hinted at this. The US is special here, and I'll come back with some evidence for the UK that puts that into context and suggests that maybe the US, being the world's safe asset supplier, is a key part of the puzzle. Another approach one could take is not use econometrics to forecast future surpluses, but instead use forecasts, for example, by Congressional Budget Office. What the Congressional Budget Office does is it makes projections based on current law. And so you could use those. And we have another paper where we actually explore that. And in some ways, actually, if you use CBO projections, the puzzles that we outline actually deepen. So if you're thinking, and it's good to be skeptical here, if you're thinking, well, I think their forecasts for surpluses are just way off, and this could be true, obviously. Be mindful of the fact that if you actually look at other forecasts like the CBOs, you actually tend to get similar results. Okay. So first, I'm going to talk about a model-free version. So one of sort of the workhorses of modern asset pricing is obviously the Campbell Shiller decomposition, and you can do a Campbell Shiller decomposition of the US debt to output ratio, right? In a way, if you think about variation in the debt to output ratio, you realize that it has to be one of three things that is driving. Either it's you expect low returns going forward relative to the growth rate of the economy, so either low returns or high growth. That is low R minus G. That is in some sense the Blanchard-Furman-Summers mechanism. That's one potential explanation for the current run-up in debt to output. And people have made that point, right? People said, well, look, don't worry about the increase in the debt to GDP ratio. Interest rates are extremely low. So that's one potential explanation. Another potential explanation is, well, no, I think that the debt to GDP ratio increase reflects higher future surpluses. So this is very much the usual discount rate cash flow channels when you think about decomposing variation, the price dividend ratio, obviously. A third possibility is, well, no, I think that the current increase in the debt to output ratio actually is just going to show up in higher future debt. That is, I don't think there's a ton of mean reversion. We're going to try and distinguish between these three possibilities using what I would say are the standard tools of the trade, right? So we're going to do standard Campbell Shiller decomposition of the US debt to output ratio. We're obviously going to look at the market value of debt relative to GDP. We're going to find that the discount rate channel doesn't seem to be doing much. Why not? Well, it doesn't look like the debt to output ratio predicts the returns on the entire debt portfolio after adjusting for inflation and growth. But then again, we also don't find evidence that the debt to output ratio predicts future surpluses with any degree of reliability. And really, we're left to conclude that most of the variation in the debt to output ratio is accounted for by the residual. That is to say, when the debt to output ratio goes up this year, it is just going to be much higher 10 years from now. In fact, almost 1 for 1. What does this teach us as asset prices? Well, at asset prices, it teaches us something interesting, I think, which is that bond prices don't seem to be very responsive to news about future macro fundamentals. And that is certainly something that I think we ought to explore. So let me briefly outline the nature of this exercise, which is a very simple one. Where you start is where you always start. If you go back to your first finance graduate class, what you do is you linearize the returns on a stock. Here, we're going to linearize the returns on the entire Treasury portfolio. So we're going to define R tilde, which is the log return R minus log inflation minus the growth rate X, that is going to be equal to rho, which is a linearization constant that should be familiar from the standard Campbell Shiller decomposition, times VT plus 1, which is the valuation ratio, debt to output in logs tomorrow, minus valuation ratio today, plus a measure of the surplus S. And this linearization goes back to John Cochran's 2019 paper. It is very similar to the standard Campbell Shiller log linearization, except of course that you have to deal with the fact that surpluses can be negative. So that's why you have this sort of approximation of the surplus there. That turns out to be not terribly important for anything I'll talk about today. If you take this equation, the first one, and you iterate forward, then you get what ought to look familiar. You get that the log of the debt to output ratio reflects the sort of properly discounted value of surpluses in the future until cap t, minus returns until cap t, plus the tail value of the surpluses. We're going to set rho equal to 1. That also doesn't seem to matter too much. It means that you're sort of expanding around the point where average returns are equal to the average growth rate. Sorry, that shouldn't be G, but X. And so what you see now is, that is just going to reflect future surpluses minus returns plus the outstanding future debt to output ratio. So you could do your standard variance decomposition where you say that the variance of the debt to output ratio can be decomposed into the part that's due to the cash flow channel, the first one, the part that's due to the discount rate channel, or the part that's due to sort of the persistence component. Okay, so if the debt to output ratio moves around, it has to be, if you're a rational econometrician, that you're either predicting higher future surpluses when the debt to output ratio goes up, lower future returns, or higher future debt to output ratio. And to make progress on this, we're just going to use the standard approach. We're going to run univariate regressions of future surpluses and future returns on the log debt to output ratio. The motivation for doing it this way, rather than using vector order regressions here, is because there's a growing body of evidence which suggests that if you use vector order regressions to make long-run forecasts, these are liable to be off because of misspecification of the VAR dynamics. So you're really sort of extrapolating in some sense when you're using a VAR to forecast very far into the future. And Jorda and others have pointed out that you're better off perhaps just sort of running regressions directly over longer horizons. So that's what we're going to do to sort of let the data speak. Okay, once you do that, what you get is actually easily interpretable. You get regression coefficients that can be interpreted as fractions in that variance decomposition, right? So the slope coefficient in regression of surpluses on the debt to output ratio BS is going to tell you the fraction of the variance that's due to surpluses. The slope coefficient in the regression of returns is going to tell you the fraction that's due to the discount rate channel. And then you have the last coefficient, which tells you how much is due to sort of that residual. And they automatically sum to 1 by virtue of the way we've constructed the surpluses. So the cross equation restriction here is baked in. So, okay, now a standard notion of fiscal sustainability would be to say, well, I expect that phi cap t is going to be larger than 1. And so, in fact, if you increase t to infinity, that the fraction of the variance due to that last term goes to 0, so that actually you have either the surpluses or the returns doing the work for you and pushing the debt to output ratio back to its mean. Of course, if the debt to output ratio does not revert back to the mean and has what looks like a unit root, then that's not going to happen, and it's not going to be sustainable. Okay, let me pause here for a second just to make sure everyone's on board. I realize that this is fairly straightforward stuff. This is just a model-free approach. In a minute, we're going to do something a bit more sophisticated, but I do want to make sure everyone's on board here. Okay. Okay, good. All right. So what do you get? All right, so if you do this variance decomposition and you don't do a bias correction, I'll talk about the bias in a second, then you get the following. At the 5-year horizon, 83% of the debt to output ratio variation is still attributable to the future debt to output ratio. At the 10-year horizon, both the cash flow and the discount rate channels start to matter, right? So in these panels that I'm showing you here, you can interpret the numbers as fractions of the variance explained by, in the northwest panel, surpluses, the northeast panel, returns, and in the southwest panel, it's future V. In the southeast panel, it's actually fundamentals. So there I'm just adding up the two top panels, the fundamentals. And what you see is that at the 10-year horizon, fundamentals do start to matter. I'm plotting 95% confidence intervals. But this is before correcting for the bias. There is a bias here, as we know from the work by Stambaugh and others. When you run these predictability regressions on persistent variables, and the debt to output ratio is quite persistent, that creates a bias in these OLS coefficients. But we know how to correct for the bias. The return predictability coefficient and the surplus predictability coefficient will both be biased upwards. They'll be too large. So we're in some sense overstating the surplus and return predictability coefficients in small samples, okay? What we're gonna do is apply these adjustments that were derived by Budok and Richardson. N here is the sample size. Cap T is the horizon, and so for each horizon and sample size, we can sort of impute a adjustment to the estimated slope coefficients that corrects for the bias. Once you do that, the evidence for predictability largely disappears. Phi here, note that phi here is the persistence of the debt to output ratio. So these biases grow larger as you increase phi. As phi approaches 1, these biases grow larger and larger. So here are the bias corrected versions of this. And what you see now is that at the 5-year horizon, basically the coefficients even have the wrong sign, okay? At the 10-year horizon, you would impute more than 90% of the variation in the debt to output ratio to the future debt to output ratio. There's basically not a lot of evidence of mean reversion, and certainly no evidence of return predictability or cash flow predictability. So there's no evidence that when you see the debt to output ratio increase, that reflects higher future surpluses or lower future returns. Our findings are different from earlier work. So Borne had found earlier that primary surpluses seem to increase when the debt to output ratio is high, and that evidence doesn't survive this longer sample. By the way, we've also used a much longer sample going back to the Civil War in the US, and because obviously, since we're dealing with very persistent series, that some sample size is going to matter, but the results seem robust to that. So we also don't find evidence that the debt to output ratio predicts real returns. As I said, there is evidence that it predicts lower returns. That was shown by John Cochran in some of his papers. But what matters here is, does the debt to output ratio predict real returns after adjusting for growth? And there we don't find a ton of evidence. So this is sort of the first sign that there's something interesting going on with the valuation of treasuries. Let me put this in the context of the literature. So discount rates on stocks we know are remarkably volatile. Valuation of stocks seems excessively volatile compared to fundamentals. And we know that high valuations imply low future returns. So this is not true when you look at bonds, right? For the entire bond portfolio, it's not true. Not the case that high valuations seem to imply low future returns. There basically is no evidence or little evidence of mean reversion in valuation ratios. Another way of saying this is that the valuation of bonds seems almost too smooth compared to fundamentals. They just doesn't seem to respond, valuation doesn't seem to respond to surpluses or future returns. Now, one potential explanation is the following. It has to be the case that an investor expects to see some mean reversion when he's looking at surpluses and returns for the entire treasury portfolio. So it could be that the investor actually has expectations that are different from the econometrician. We've so far put on our rational expectations hat and assume that investors develop expectations pretty much the way an econometrician would. But it's entirely possible that that's not what investors do. If investors were to systematically overpredict surpluses when the debt to output ratio increases, that could explain some of our findings. So if you go back to that Campbell Shiller decomposition, but now you use F to denote subjective expectations, then we could rewrite it as that second term reflecting the difference between F, subjective expectations of future surpluses and returns, and E, the econometrician's expectations of surpluses and returns. So if that forecast error systematically varies with V, that could explain part of our findings. Of course, need empirical evidence to sort of base that claim on, and we're going to look at the CBO's projections. So we're basically going to say, well, what if investors develop expectations of future surpluses the way the CBO does? And at least for 1 year ahead surplus forecasts, the CBO and the private sector seem to have forecasts that co-vary quite strongly. The private consensus economic forecasts are actually a bit more generous, less conservative than the CBOs. I should add here that the CBO doesn't really produce forecasts. They are projections, long-term projections based on current law. So the CBO does not try and anticipate large fiscal corrections. Okay, what we've seen, interestingly, over the last 2 decades is that the CBO has systematically overpredicted future surpluses. On the right-hand side, we plot surplus to output ratio forecasts. So each year, the CBO develops 10-year ahead forecasts, which are plotted against the actual realizations, which is the black line. And what you see is that these forecasts, projections, systematically exceed what actually happened over the next 10 years. So the CBO was constantly projecting large surpluses that subsequently didn't materialize. On the left-hand side, we plot the debt to output ratio. Again, forecasts 10 years ahead, plotted against the actual realization. And so the fact that they overpredict surpluses translates into a systematic under forecast for the debt to output ratio. So the CBO systematically expects mean reversion to kick in when the debt to output ratio goes up, and it subsequently doesn't seem to happen. And these gaps, as you can tell, are actually pretty large. So on the y-axis here on the left-hand side you have the debt to output ratio. You see wide gaps opening up between systematic wide gaps between what's actually forecast to happen and what subsequently transpires. Now, here's the interesting thing. If you rerun these regressions, but you actually put the CBO forecasts on the right-hand side, on the left-hand side, instead of the actual realized surpluses, then what you see is actually you tend to get more evidence of surplus forecastability. Okay, so the variance decomposition now imputes a larger fraction, the red line, quite a bit larger actually, to surpluses. So there's some evidence that these systematic forecast errors might have led investors to impute too much mean reversion to surpluses. Okay, let me round up here this discussion of sort of the Campbell Shiller decomposition by saying that if you just sort of take a model-free approach, looking through the lens of that Campbell Shiller decomposition, that what you find is that the bond market's valuation is really not very responsive to news about future surpluses or returns. That's kind of the key fact. And in fact, it's kind of hard to reject the null of a unit root. Of course, we all know that these unit root tests have low power in short samples, but we also looked at a really long sample, didn't get to talk about that, and we found very similar results. It could be that investors are making systematic forecast errors, that they actually expect mean reversion in the debt to output ratio, even when the econometrician does not. And I've shown you some tentative evidence from CBO projections. If investors have expectations that are in line with CBO projections, that certainly suggests that could have played a role. But I think there's a lot more work to be done here in trying to understand. So just taking a step back, once you start to look at the valuation of the entire portfolio, rather than focusing on the individual bond returns or individual bond prices, which is what we were mostly in the business of doing in financial economics, you actually learn some new facts that are somewhat puzzling from the perspective of standard models, this sort of lack of responsive valuation of bonds. What I want to do next is sort of put some more meat on the bones and actually commit to a flexible dynamic asset pricing model and see what we can learn from doing that. Let me pause here to see if there are any new questions.
Hanno, did you say that this looks different for other countries? You find that fundamentals, quote unquote, play a bigger role or anything like that? Can you tell us?
Well, what we did was not quite this exercise, but we actually did a version of the more structural approach, which I'm going to outline next. So next, we're going to sort of commit to an asset pricing model. And we're going to do this for the US and find that it's hard to rationalize the valuation of debt, but we did the similar exercise for the UK. And there we actually find smaller gaps between the market valuation of debt and the measure of fiscal capacity. So I'll come back to that in a second, but no, we have not done this specific exercise for other countries. I think that'd be actually a very natural and an interesting thing to do. To be honest, I don't know what will come out of that. The main driver here, obviously, is the persistence of the debt to output ratio. So if you look at another country where the market valuation of debt relative to GDP is equally persistent, I think you'll find similar results. But I suspect that there are a lot of countries where it's not quite as persistent. And in fact, I would conjecture that if you did this, for example, for emerging market economies, you'd find a lot of evidence of cash flow predictability and of the discount rate channel, but that's a conjecture. I actually haven't done that, but that would be a natural thing to check.
There's a question in the chat. Julian, do you want to jump in?
Sure. So I found the chart you showed just before super interesting about the surpluses. And there is one I have in mind, which is about interest rates. And so if you plot the same thing about expected interest rates, say the Fed funds rate and the actual one, you would see that the actual is actually lower than expected. So that would have an effect, a role for valuation, I guess, which would be the opposite of what is shown here for surplus. So that could explain the fact that valuation is not that volatile, or am I missing something?
That's a great point. It certainly is true that over the past few decades, if you look at interest rate forecasts, most analysts were systematically forecasting mean reversion to higher levels, right? And that subsequently did not happen. That's true. That is actually in our exercise, we sort of take that into account because the CBO actually makes interest rate forecasts. So when they make their forecasts for future debt to output ratio, their projections, I shouldn't call them forecasts. They don't like it when you do that because they're really not, they're projections. But when they project debt to output, say in 2050, they also embedded in that have a projection of interest rates between now and 2050. And I suspect that their interest rate forecasts behave the way you described. So I think that's in here in this exercise. It's just that the surplus channel is what dominates. The fact that they expect so much mean reversion in surpluses imputes a lot of mean reversion to the debt to output ratio, which doesn't happen. But yes, you're right. If you look at interest rate projections, there are similar systematic biases to be found over the past 2 decades. That's a very good point. Yeah.
Okay, thank you.
Yeah, by the way, if you're interested, so the CBO does a very careful job of documenting how they come up with these projections, right? So you can go to their website and download these and you can reconstruct exactly how they came up with these forecasts. So they give you all the inputs and you can tweak them. Okay. So now what I want to do is really get into what I think is, for this lecture at least, the main dish. Now we're actually going to put a model on the table. I'm going to commit to a model for cash flow dynamics and for asset prices, and then just price that claim to surpluses and see whether we can make sense of the valuation of US debt. And then I'll talk a little bit, as I explained to Alexei, about the UK as well, which is very interesting. The UK, by the way, is a very interesting country to study, not only because before the First World War, it was sort of in a similar position to the one the US is in, of being the world's safe asset supplier, but it also has excellent data. So there's this thing called the Millennium Project, run by the Bank of England, which has historical data, macro data, financial data. You can value the entire portfolio of gilts outstanding all the way back to the early 18th century. So the data is really excellent. And as you know, even if you are not a history fanatic, a lot happened in the 18th and 19th century in British history. And so there's a lot of action in deficits and spending and the debt to GDP ratio. Okay. So what we're going to do now is commit to a model for cash flow dynamics. So we're essentially going to say the US federal government adopts a spending and a taxation rule. I'm going to define tau to be the log of tax revenue over GDP. G is going to be the log of spending over GDP. And we're going to assume that tax revenue and GDP and spending and GDP are co-integrated, right? So in the long run, they're going to co-move. That's the key assumption. In the short run, tax revenue growth in logs and spending growth can depend on the lagged variables. And so fiscal shocks can temporarily push the level of tau and G away from their long run equilibrium. But in the long run, they're just going to move with output. And we sort of check that this model delivers reasonable impulse responses and develops pretty good forecasts over the longer run. Okay. Important to think a little bit about what this implies. So once you have spending and tax revenue co-integrated with output, so these ratios are stationary, then you can show that if you had, say, a strip of spending that is a claim to government spending 50 years from now, or a claim to the Treasury's tax revenue 50 years from now, and you compute it, the expected return on these strips, what you can show is that those would be much higher than the long end of the risk-free yield curve. Why? Well, the long-run discount rates on G and T are going to be equal here to the long-run discount rates on GDP, an unlevered equity claim. Okay, and these are much higher than long-term risk-free bond yields because they're permanent shocks to marginal utility. There's a long line of work going back to Alvarez and Yerman, Hansen, Schenkman, and Backus, Boryachenko, and Chernoff that sort of documents the importance of these permanent shocks to marginal utility. And what these do is they make claims to output strips much riskier than long bonds. Okay, that's really where the equity premium comes in from these permanent shocks to marginal utility. So we're going to put a model on the table that has these permanent shocks to marginal utility. What this means is that you're discounting future surpluses at a much higher rate than the long end of the yield curve. Okay, that's the inevitable conclusion in a model in which spending and taxes are co-integrated with GDP. Okay. Now you could say to me, well, I don't think that there are these permanent shocks in the world. I believe that we live in a world where these things follow a deterministic trend and then they kind of deviate in cycles from that trend. Well, that model would have very counterfactual asset pricing implications. That's basically the point of Hansen and Schenkman's work. In that model, the long bond would be the riskiest asset, which is counterfactual. And so that's why you need to commit to a model with these permanent shocks to marginal utility. But that already creates a bit of a tension, right? Because we're now committed to discounting future surpluses at higher rates than the ones we use for the long end of the yield curve. Okay, so these cash flow dynamics are going to matter. We're going to use a flexible VAR to forecast these surpluses. These are the elements of the state factor. We got inflation, the short yield, the yield spread, GDP growth, dividend growth, tax revenue, GDP growth, and spending to GDP growth. As I said, we're imposing co-integration between spending and GDP and taxes and GDP. And that's why you have these, the levels of these variables in there as well. First, what I'm going to do is sort of compute a simple model-free upper bound on fiscal capacity, and then I'll give you the full-fledged estimate. Okay. All right. So now let's start by thinking about what is the expected return on a risky claim, the expected return on a claim to spending or on a claim to tax revenue. Well, it'd be equal to the short rate plus the yield spread, both of which are included in our state factor, plus some risk premium, RP. This could be the risk premium on the tax claim or the spending claim. What we can do here first, just to do some back of the envelope calculations, is we can use a log linearization and derive a Campbell Shiller expression for the valuation ratio of the tax claim, the valuation ratio of the spending claim. Let's assume for now that these risk premia on the tax claim and the spending claim are constant. I'm going to relax that assumption later on. This is just to derive some back of the envelope simple numbers. what you get then is that the implied debt to GDP ratio is given by the taxes over GDP ratio today times the valuation ratio of the tax claim minus G over Y, spending over GDP ratio times the valuation ratio of the spending claim. And these valuation ratios are determined by the standard factors. You have the discount rate component, the short rate plus the yield spread plus the risk premium, and the growth rate component, real growth plus inflation. Okay. All right, let's stare at this equation over here, but now let's put the state factor evaluated at 0. So we're kind of at the long run average. What is the steady state value of the debt to output ratio? Well, it's just tau 0, the taxes over output ratio times the steady state valuation ratio of the tax claim minus spending over output times the steady state valuation ratio of the spending claim. Okay, now let's go back and think about fiscal capacity here for a second. So it is true that a country could run steady state deficits and have positive debt to output ratios, but the only way you can do that is, and you can sort of see that just by staring at these equations, if the risk premium on the tax claim is lower than the risk premium of the spending claim. That's what I was trying to get at earlier, right? The only way you can do this is by shifting aggregate risk to taxpayers away from the bondholders, right? You have to make the tax claim less risky. But we know that this is hard to reconcile with countercyclical fiscal policies in the US. And by the way, this is true regardless of the short rate and the real growth rate of the economy. So it's not enough to just look at interest rates and the growth rate, because that really, in this view of the world, doesn't tell you anything about whether you can run deficits or not. The only way you can run deficits here is by making the tax claim less risky than the spending claim. We know from our analysis of the data that the business cycle risk goes the wrong way. The tax claim is much riskier than the spending claim. We assume that in the long run, they're co-integrated. This is where I had this exchange earlier with Alexei. And so what we're going to do is say, let's derive an upper bound on debt capacity by simply setting the risk premium on taxes and spending equal to the risk premium on output. That's an upper bound because we think that the actual risk premium is higher for the tax claim than for the spending claim. Okay, and we're going to take a number for the unlevered equity premium of 3%, which seems like a reasonable number if you look at the data. Earlier, I showed you evidence from that paper by Backus, Chernoff, and Martin that says, well, 3% seems like a reasonable number for an unlevered equity premium in a state-of-the-art dynamic asset pricing model. Later on, we're going to estimate all these things. Here, I just want to illustrate what happens if you take the simple approach. Okay, so now we can go back to this equation that I had here, right? But now we know that the valuation ratios are the same because I'm assuming they have the same risk premium. So things become even simpler. And I get a valuation ratio of 57 for the GDP claim. So what this says is for every % primary surplus, the US gets a debt capacity of 57% of GDP. So that's quite generous. It's a high valuation ratio, right? And it's a high valuation ratio because the US has had a fairly decent average growth rate and interest rates are low. What does that amount to? Well, if you look at sort of the average numbers in our sample, the US actually hasn't been running surpluses. The average primary surplus is essentially 0.05%. So the actual debt capacity on average that you get out of this is very low. And the reason is quite simple, because the US is in the remarkable position of not having run primary surpluses over the past 8 decades or so. And by the way, that's very unusual. I think because we're so used to looking at US data, we think that that's typical for most countries. I'll show you evidence for the UK. the UK has been running primary surpluses throughout its 400-year history of around 2%. I shouldn't say throughout its 400-year history, throughout the 400-year sample we observe. So the US is quite special in this sense, actually. It just hasn't been running primary surpluses, and that's why the average debt capacity is very low. Now, the only free parameter here is really the risk premium on debt, right? And so if you wanted to get around this conclusion, what you'd have to do is push that risk premium on GDPY, RPY, down dramatically to increase that valuation ratio and to get from that small primary surplus to a bigger debt capacity. So that is what gives you an upper bound. So in the benchmark sample, you don't get a lot of debt capacity. You get about 3.15%. What's needed to rationalize 100%? Well, you'd have to believe that the US would be running primary surpluses on average of 1.74%. Okay. Now you might say to me, well, Hanno, I don't think that's a big gap between 0 and 1.74. Actually, I think it is. If you look at CBO projections from here out until 2050, the latest ones project deficits of 3.9%. So we would have to get from 3.9% deficits to 1.74% surpluses, right? So that's a swing of about 5% of GDP. That is huge by objective standards. That would be an almost unprecedented fiscal correction. Just to give you a sense of what we're talking about, I think the defense budget in the US, correct me if I'm wrong, is about 3% of GDP, right? Which is actually a lot. As you know, the US spends quite a bit on defense. So these numbers are large numbers. This is just to provide some context for the results that I'll develop in the full-fledged model, just to give you a sense of where these numbers come from. Okay, now we can compute this upper bound dynamically just using our vector order regression, and what you get now is you get the red line, which is this upper bound. The blue line is actual debt to GDP. And so what you see is that pretty much throughout the sample, the blue line is above what we call the upper bound, right? So there's just a systematic gap between this upper bound and the actual valuation of debt. But certainly over the past 2 decades, we've seen a dramatic increase in the size of that gap to where now it's about 1 GDP. So there's a substantial gap. One thing I haven't talked about yet is sort of convenience yields, right? So natural other question is, well, what if you have convenience yields? Let's say convenience yields are 60 basis points on average. What you have to do then is compute the seniorage revenue that implies as a fraction of GDP. And it's not negligible. It's about 0.25% of GDP, but it's not big enough to really make a dent. So now you get the steady state debt capacity up to 15%, but still well short of what you actually see in the data. And this is the dynamic upper bound with the convenience yields, where each period we sort of take into account the total amount of actual seniorage revenue that the US government earns by taking our measure of convenience yields, multiplying it by debt outstanding. And it really doesn't change the calculations fundamentally. In order for them to really matter quantitatively, you'd have to think that convenience yields are quite a bit larger than our measure suggests they are. Okay.
I don't know, just real quick in that picture,
Yeah.
you said before that from the 40s to the 60s, we kind of grew our way out of the debt.
Yeah.
Why is that still showing as a violation of the bound? Like it just seems like even then the puzzle looks as big as now, whereas I thought the puzzle was more now.
Right. So
just the debt
of course,
was so high, something. Yeah. Go ahead.
Yeah. Okay. So that was a backward-looking sort of exercise, and what we said there is, look, in the 50s and 60s, you saw very high growth, and that is exposed what helped the debt to output ratio come down. Now, our model should take that into account. It sort of develops this dynamic version. It predicts GDP growth, right? And to the extent that it does a good job predicting GDP growth, it should have maybe anticipated at least part of this, and that should have been reflected in an increase in debt capacity. But I think the bottom line is that throughout this period, the US really was not running large primary surpluses. Ultimately, you're taking the primary surplus and multiplying it by that valuation ratio, which you're adjusting dynamically. And I think the primary surpluses were still fairly small throughout this period. So I would say that the US didn't really bring the debt to output ratio down by running large primary surpluses. It came down mostly through growth, a little bit of inflation as well. And I think that's probably what explains the discrepancy between that backward-looking lens and what we're doing here. So the reason that that red line doesn't really go up perhaps as much as you think is related to the fact that primary surpluses were still small. Having said that, though, you do see that the blue line and the red line sort of from the 70s to the 90s are closer together. And then after that, you again see a wide gap opening up. By the way, I've also plotted 95% confidence intervals for these upper bounds. Okay, we do some robustness where we sort of look at lower risk premia. Lowering the GDP risk premium doesn't completely solve this problem because the primary surpluses are too small. So really what you'd have to do if you really wanted to match the blue line is you'd have to lower the risk premium on the tax claim below the risk premium on the spending claim, right? So some people have told us, well, look, why don't you just reverse engineer the risk premium on the tax claim that sort of makes the equation hold? You could do that, but the problem is then that you end up saying, well, I think the tax claim is much less risky than the spending claim, which seems completely counterfactual. So that's just another way, I think, of restating the puzzle. Okay, and the last thing that I want to do is sort of do the full-fledged asset pricing exercise, where we commit to a pricing kernel. What happens then is that you get these sort of covariance terms. So if you go back to the intertemporal budget constraint, the debt valuation equation, you could say that the first part is the part where you're just pricing everything off the yield curve, right? That's this first equation over here. But then you have to add these covariance terms. These are risk premium terms, and they both go in the wrong direction in a sense. They're both going to reduce fiscal capacity. Why? Well, because the tax revenue is risky and the spending claim is safe. And so that, and you're long in the tax revenue claim, short in the spending claim. What model are we going to use? You could basically, and in a way, this is kind of an invitation to all of you to think about this, right? You could do this with almost any dynamic asset pricing model. We thought, well, first, we don't want to put too much structure on this, and it is a bond pricing problem, so let's use a bond pricing model. We decided to go with the dynamic term structure model that was pioneered by Andrew Ng and Monica Piazzesi. It's a model in which the pricing kernel in logs is given by this following expression. YT1 is the short rate. Lambda t is the vector of risk prices. The risk prices here move around with the state variable. We estimate lambda 0 and lambda 1 to match as closely as possible the yield curve, as well as moments of stock prices. And then we're going to look at what those estimates imply for the valuation of these claims to taxes and spending, because that's ultimately what we're interested in. roughly speaking, in this model, it is still true that the log of the price-dividend ratio on the tax claim, for example, is still affine, roughly speaking. It's not exactly, but and so the same forces apply, right? The price-dividend ratio is going to be determined by the expected return on the tax claim in excess of the growth rate and the rate of inflation. That's pi d0 is the average price-dividend ratio in logs on these claims. You could do the same thing for the spending claim. And then the valuation of the surplus claim is just going to be given by the difference. So you take T times the price-dividend ratio on the tax claim minus G times the price-dividend ratio on the spending claim. And what you get is the following, and not surprisingly, given what I've told you, you get a lower valuation ratio for the tax claim than the one for the spending claim. Why is that? Well, this model tells you, wait a minute, that tax claim is riskier than the spending claim. I'm going to impute a lower valuation ratio. So now you take taxes over GDP of 17% times 71 minus spending over G of 17.5% times a higher valuation ratio of 78, and you end up with a negative measure of that capacity. As I was trying to explain to Alexi, the only way to get out of this conundrum is to increase the valuation ratio on the tax claim. But the model doesn't want to do that, because the model says, no, I've looked at the tax process, compared it to the spending process, I think the tax process is riskier. So that's fundamentally where this result comes from. So now if you plot the present value of surpluses over GDP against government debt, this is the picture you get, okay? So you get even bigger gaps opening up than what I'd shown you before. The upper bound that I'd shown you before was mostly in positive territory, but this present value measure itself is mostly in negative territory, and it's all driven by the fact that the valuation ratio for the tax claim is lower. As I said, if you wanted to be able to run deficits forever and have a positive debt capacity, you would have to have a higher valuation ratio for the tax claim. That is fundamentally the puzzle. So what are the drivers? Well, let me plot the cumulative risk premia on these strips. So we have the spending claim G, the tax claim T. And so compare the blue line to the red line. What you see is that the spending claim initially is much less risky than the tax claim over short horizons. In the long run, they converge to the GDP risk premium. That's by construction because they're co-integrated, right? So this model says, well, hey, in the long run, these things are all equally risky. I'm going to assign the same risk premium to them. But in the short run, you can have these discrepancies, but of course it goes the wrong way. The tax claim is set to be more risky than the spending claim by this model, and that explains the higher valuation ratios for the spending claim and the tax claim. So it's the short-run discount rates that are driving things. The long-run discount rates are the same. Okay. Now, what could be going on here? Well, one explanation would be maybe what we're missing, and I think this is a serious possibility, of course, is that there's this probability of a huge fiscal correction that just hasn't happened in our sample, right? There's this small probability phi of a permanent spending cut. Let's look at a spending cut where you cut spending from 17.5%, which is the average, to 10.5% of GDP. So the interesting question then is, how large does the spending cut phi have to be in order to sort of fix the whole problem? In order to equate the market value of government debt to the present value of surpluses. So you can back that out and reverse engineer it. So these are the probabilities you need, okay? And one thing I take away from that is that, well, this is not really a peso problem because the probability is just too darn big. on average, it's 32%, right? This would have been a more appealing explanation if it was much, much lower. So it's almost as if US bond market investors wake up every day and say, today is going to be the day when we finally are going to see a large fiscal correction, but then it turns out that it doesn't happen. So in a way, it's a restatement of the puzzle. I think it's the right thing to think about. It must be at some level that investors are anticipating large fiscal corrections, but it seems like they don't have rational expectations, at least not from the perspective of our model. Another way of thinking about this, I think, as well, if you think our model sort of misspecified in a way in terms of the surpluses we predict, then this is kind of sort of the how far we should be off, right? And this says you're off by a lot in some sense. That's another way of interpreting what we're doing here. So coming back to Sargent's original approach, so when Sargent wrote down the intertemporal budget constraint of the government, he said, look, we need to think about how investors develop expectations of future surpluses, and he committed to investors with rational expectations. That's what you need to do in order to be able to really sort of test this equation, right? Without some way of measuring the present discounted value of surpluses, you can't get anywhere. And what we're saying here is, boy, it's hard to rationalize the valuation of the debt if investors have rational expectations, because if you really want to match the value of debt, they just seem to be constantly waking up. It's almost like Groundhog Day, right? Where you're Bill Murray, every day you wake up and you think today is going to be the day, but it doesn't happen. Okay. Another potential resolution, of course, is, and I want to come back to that briefly, and I don't want to dismiss it, is that bond markets are not enforcing the transversality condition. You could think about what we're measuring here is the size of the bubble from the perspective of those models. Do note, though, that in our model, literally speaking, the transversality condition does hold, because there is a large risk premium in our model endogenously. That's what the model wants. It says, look, a claim to GDP is risky, and that's why that transversality condition holds. As I've said, these transversality condition violations are hard to sustain when you have long-lived investors in the model. It raises all sorts of questions. If the US could do it, why not Argentina? If the Treasury can run a Ponzi scheme, why not a AAA rated corporate? And there's also evidence, for example, from some recent work by Mike Chernoff, Lucas Schmidt, and others that sovereign CDS spreads in the US are actually sensitive to fiscal news, which seems hard to reconcile with this idea of a rational bubble. Okay. So let me conclude here by saying that if you look at a simple portfolio strategy that buys all outstanding treasuries, it produces risky cash flows. And when you try to value that claim, you run into this puzzle. The puzzle suggests that bond yields are really too low, that the market is overvaluing the debt claim. It could be that bond market investors fail to enforce the transversality condition for the US. It could be that convenience yields are actually much larger than we think they are. It could also be, and this goes back to what I was saying before, that perhaps investors hold excessively optimistic beliefs about future fiscal rectitude. Just to round up, what I want to do is show you a little bit of evidence from the UK in a few slides, and then we'll be done and perhaps leave some time for questions. But let me pause here and see if there are any questions. This is a bond market vigilante cartoon that I really liked. I stole it from a Wall Street Journal op-ed. So as some of you probably know, in the later years of the Clinton administration, the bond market vigilantes appeared. So the bond market all of a sudden became worried about large deficits in the US, and it essentially forced the Clinton administration to start running large surpluses. And so there was a lot of talk back then about bond market vigilantes, but they seem to have disappeared after that. Okay. If there are no questions, then what I'll do is simply round up by talking briefly about what I think is a key piece of the puzzle. So I've shown you evidence that it's hard to rationalize evaluation of debt in the US. And I think the US's status as the world's safe asset supplier might have something to do with that. And I'll show you some brief evidence for that. There are theories of safe asset demand that sort of predict that if you're the designated safe asset supplier, just by virtue of that designation, your debt becomes safer because there's some strategic complementarities. And there's some work by Hal Cole and Tim Kehoe, Sigwo He, Arvind Krishnamurti, and Konstantin Milbrandt and others that sort of spells out how these mechanisms work. I'm going to show you some evidence from the UK that's consistent with this. So before the First World War, the UK was really the world's safe asset supplier, and it benefited from extra fiscal capacity, as I'll show you in a second, but it lost that privileged status after the Second World War. So what we did here, and this is joint work with Zifeng Cheng, Xianyang Yang, Stan and Mindy, is we computed that same measure of fiscal capacity, that upper bound that I outlined before, for the UK. And I'm going to just show you some numbers where I divide that number of fiscal capacity by the valuation of debt. Okay, so you could think of FC over D as the fraction of debt that is backed by surpluses. Okay. So what we find is that between 1729 and 1914, around 80% of the debt in the UK is backed by surpluses. So the UK seems to have this ability to supply more debt than what is warranted by reasonable forecasts of its surpluses. And the way we compute these numbers is just using the methodology that I outlined before, where we impute the GDP risk premium back out a valuation ratio and then run these numbers. So in a country supplying the global safe assets, less than 100% of debt backed by future surpluses, what you see is that after the First World War, when the UK lost its safe asset supplier status, and by the way, the evidence for that is very strong. After that, the UK was systematically borrowing at rates that were much higher than rates in other countries, whereas before they were much lower, even though the UK had much higher debt to GDP ratios. So after the Second World War, what you see is that fiscal capacity now systematically exceeds the valuation of debt. So it seems to borrow less than its fiscal capacity. Here's a graph for fiscal capacity, and the upper bound is the present value surpluses. That's the red line. The blue line is the actual debt to GDP ratio. And as you can tell, the UK issued a ton of debt in the early parts of the 19th century, of course, because it was fighting the Napoleonic Wars. And so after Waterloo in 1815, they were left with a debt to GDP ratio of around 170%, so, which is really quite remarkable. This was in the 19th century, obviously, when the tax base of even an advanced economy like the UK was much smaller. And so you see a big gap open up between the valuation of debt and fiscal capacity. But, and I think this is interesting and in some ways a validation of our methodology, there's a very high correlation between our measure of fiscal capacity, the red line, and the blue line. It's not that they are not related. In fact, the correlation is 0.9. So I think our fiscal capacity measure sees through these wars, understands that these are transient and kind of just measures the present discounted value of surplus is pretty much the way bond investors do. But bond investors still allocated some extra fiscal capacity to the UK. Although you do see that towards the end of the 19th century, the blue line and the red line seem to converge. And in fact, during the First World War, they're essentially pretty much on top of each other. Look at the contrast with what happens after the Second World. After the Second World War, the upper bound really is an upper bound. The red line is always above the blue line, and the UK doesn't, or at least seems reluctant to, or cannot, hard to tell those two apart, borrow more than its fiscal capacity. This, I think, is consistent with this idea that if you're the global safe asset supplier, you do get this extra bit of fiscal capacity. That could be a part of why the US has been able to do what it does for the past 70 or 80 years. I guess the takeaway from the UK experience is that at some point you could have exhausted your exorbitant privilege in some sense, and when it disappears, it tends to go away rather quickly. In a matter of 2 decades between the First and the Second World War, convenience yields that the UK Treasury earned completely disappeared, and that has also, as I show you here, affected its ability to tap debt markets, to finance wars, et cetera, et cetera. Okay, let me pause here. Wanted to say that I have made these slides available, and they include links to most of the papers that I've cited in case you want to take another look at these slides. So feel free to email me if you have any questions for me. But I'd be glad to take a few more questions. Sorry, Alexei, go ahead.
Yeah, I was just going to say that there's a question in the chat. If you want to take it.
Yes, please.
Alessandro Rebucci. Alessandro, do you want to jump in and ask it?
Yes. Thank you, Hanno, for this very interesting presentation. So as you know, the standard what you term the backward-looking framework is used to look at the sustainability of the external position of countries, and the US position has been long regarded as puzzling. So there, the challenge is that it is financed with a variety of instruments, right? Not all of them should be risk-free. But I wonder which part of this framework could be helpful to revisit that question of what is the secret of the sustainability of a seemingly unsustainable external position here.
That's a great question, Alessandro. I think you're right that in principle, the methods that we're using here, especially in the forward-looking approach, could also be applied to thinking about sustainability with respect to the net foreign asset position of a country. And so you could think, well, I'm going to try to value a claim to future current account surpluses, right? And I'm going to commit to an asset pricing model, and then I'm going to evaluate that claim and see if I can make sense of this. I think, there is a sense in which that is what Hélène Ray and Pierre-Olivier Gouin-Shaw have done. But I guess what they did was sort of take a more model-free approach in the sense of the Campbell Shiller approach. I would say that their paper is an example of the Campbell Shiller approach to the net foreign asset position. But you could also take sort of a slightly more structural approach, commit to an asset pricing model, and then revisit all these questions. I think that would be very interesting.
I was thinking exactly about that, but if I'm not mistaken, now I haven't read the paper in a while. There is no uncertainty, right? There is simply the log linearization of the external intertemporal budget constraint, and then a decomposition of the return in valuation versus yield, and so on and so forth.
That's right.
But there is no modeling of uncertainty and the pricing of that uncertainty.
I think that's right. So the interesting thing to do would be to confront the risk and the uncertainty and sort of price it and see how far one can get. I think that's a very interesting idea, Alessandro. Yeah, I agree. It's a good point. Thank you.
Thank you, Zoyo. It's very interesting presentation.
Awesome. Are there any other questions? We have almost no time, but if there's anything else. Okay. Awesome. As Hanno said, the slides are online. They'll be posted on the MFS website, and you'll be able to see them there. The recording will also is on Facebook right now, but it will be on YouTube later as well. So feel free to revisit. Thank you very much, Hanno. This is super important stuff. I think one of the big questions of our time. So it's really great to see how you think about it, and hopefully a lot more research to be done in the area. So thank you very much.
Thank you. Thanks for giving me this opportunity, and thanks to everyone for listening. Thank you.
Thanks a lot. We'll be back tomorrow with Dimitris Papanikolaou. See you guys.